Today we're doing something a little different. We're not just looking at a company, we're learning a professional framework for how to analyze one. Now this isn't a stock tip, it's a look under the hood at how a serious fund investigates an opportunity. And we're going to use Data Patterns India as our case study.
You know, as an investor, you're just constantly bombarded with noise, right? You hear about the next big thing, the can't-miss opportunity, but how much of that is just a good story and how much is a genuinely solid business?
And that's the fundamental challenge, isn't it? Separating the hype, the stories that sound amazing but are basically built on quicksand, from the real deal, high-quality businesses with real durable strengths. One actually builds your wealth, the other, well, it just makes for a good headline for a day.
Right, so the big question is, how do you actually get good at telling them apart? That's exactly what we're going to tackle here. We're going to see how professional-grade analysis cuts through all that noise to find out what's real.
To do that, we're going to put on what I'm calling the 1,000 crore lens. This means we're going to think like a fund manager who's about to write a massive check. No shortcuts, no getting swept up in emotions, just a cold, hard, forensic look at the facts.
Okay, let's dive in. Our case study is Data Patterns, a company in the super interesting high-tech defense electronics space. It's the kind of business that gets a lot of attention from the big players, which makes it the perfect subject for our investigation.
And this right here, this is the core question we need to answer. Is this a business that can grow steadily for years and years, a durable compounder? Or is it a company that's just enjoying a temporary boom, a cycle peak supplier that could just fizzle out? Because, let's be honest, the answer to that changes everything.
So, a quick first-pass filter shows us exactly why this company is so interesting. Look at this. It ticks a ton of boxes. Strong sector, fantastic profitability, and great growth. But, and this is a big but, notice those yellow warning signs. Promoter holding is a little below the 55% we'd ideally like, and there's a really high dependence on a single customer, in this case, the Ministry of Defense. So it's not a perfect story, which is exactly why a deep dive is so essential.
So this is where it gets really important. We have to understand the business itself. What gives it a competitive advantage? What investors call a moat. What's the wall that protects it from competitors trying to eat its lunch?
Now, here's a really critical distinction. Data Patterns isn't just assembling parts. They are deep in the world of high-margin defense electronics. This is a whole different ballgame. We're talking about intellectual property and creating situations where, once you're designed into a major platform, it's incredibly painful and expensive for the customer to switch you out.
And this slide just illustrates their moat perfectly. I mean, think about it. To become a supplier for a missile system or a new radar platform, a company has to go through this incredibly long and difficult 5 to 10-year qualification cycle. Once you pass all that and you're integrated, you are locked in. It's just way too risky and way too expensive for the customer to even think about replacing you.
All right, let's switch gears and move to the financials. A great story is one thing, but the numbers have to back it up. And we're not just looking for any growth, we're looking for quality growth. Now here's a fascinating and kind of counterintuitive point. In a lot of businesses, you want to see that smooth, predictable, quarter-on-quarter growth. But in project-based defense electronics, perfectly smooth growth can actually be a huge warning sign that the numbers are being, managed. The reality is that revenue in this sector is naturally lumpy. It comes in as big projects get delivered at different times. The fact that Data Patterns revenue reflects this unevenness, that actually boosts its credibility. It suggests they're reporting honestly, not trying to artificially smooth things out for the market. And the rest of the financial picture is very, very strong. The profitability, measured by ROCE, is excellent. The company has almost no debt. Crucially, the cash flow follows the profits, which means they aren't just booking sales on paper, they're actually collecting the cash. And their margins have held up as they've grown, which suggests they have real pricing power. So let's recap. We've established it's a high-quality business with a strong moat and squeaky clean financials. But our investigation is not over. The final, and you could argue the most important question, is this. What is the right price to pay for all this quality?
See, a professional analyst never bets on a single future. They think in terms of probabilities and different scenarios. For Data Patterns, the analysis suggests there's about a 55% chance of a solid base case, a 25% chance of a bull case where everything goes perfectly, and a very real 20% chance of a bear case where things go wrong.
Let's break that down. The bull case requires near-perfect execution and major success in exports. The most likely base case sees strong, but a little more moderate growth. And the bear case, which could be triggered by things like program delays or budget cuts, could see growth slow down quite a bit.
And this brings us to the brutal truth of the matter. The analysis shows that at its current market price, the stock is already pricing in a future that looks a whole lot like the base case, maybe even with parts of the bull case sprinkled in. What that means is there's very little room for error, or what investors call a margin of safety.
So, after all this digging, what's the final verdict from our billion-rupee investigation? Well, as you've probably guessed, it's not a simple buy or sell. The professional answer is far more nuanced. The verdict is conditional approval. This means, yes, the business is excellent, but because the valuation is so high and there are real execution risks, the investment strategy has to be smart. You can't just throw all your money in at once.
And this is exactly how a professional fund would manage that risk. They would deploy capital in phases. You start with a small position. Then you only add more money after the company proves it can execute, after it shows real progress on exports, and only when the price makes more sense. It's about making the company earn the right to a full investment.
So, the key takeaway from this whole explainer isn't really about data patterns itself. It's this 5-step framework. By starting with a core question, analyzing the moat, checking the numbers, assessing the price, and then building a strategy, you can apply this billion-rupee lens to any investment you consider.
And that leaves us with one final, crucial question to think about. What's ultimately more important? Finding a truly great business or making sure you buy it at the right price? The answer lies at the very heart of successful long-term investing. Thanks for watching.